Hello, everyone. Today I'm going to discuss Greeks, what they are, and how they're used, how to understand them. All right, as you all know, we have delta, gamma, theta, vega, and rho. Right, and I've got them kind of split up here on my option chain. So theta is here, delta is here, gamma, vega, rho. Okay, so to start, we're going to discuss delta. All right. In some ways, people use delta to represent the probability the strike will be in the money. Right, so assume you purchase a long call option with a delta of zero point 0.5, which is what I've got highlighted here, zero point 0.5. This would basically mean that it has a 50% chance of expiring in the money to date, right? So on this current time frame and current price, it has a 50% chance of expiring in the money. Okay. So delta more specifically represents the rate of change between the option's price and a dollar change in the underlying asset's price. The price sensitivity of the option is, basically relative to the underlying asset. So if the delta's rate of change is 50, right, so 0.50, and the stock price moves up a dollar, right, then the contract would go from 165 to $2.06, right? So as you get further away from the money, the delta value changes. And this is in relation to gamma, which is what I'll explain next. Right? So gamma, this is the rate of change in the delta of an option. Right? So gamma values are largest when you're at the money. Right? So as you can see here, gamma's the highest when you're closest to at the money. Right? Now, obviously they're going to be much smaller the farther out of the money you go. The sensitivity of gamma exponentially increases as expiration nears. All right, so gamma is important to keep in mind when hedging, um, especially the understanding the deltas, because low gamma positions require less maintenance than a high gamma position. So as an example, this would be if this current scenario being a 0.09, if the option price were to change from say 25.50 to 26.50, then the delta value would change roughly 9 cents, right? So if you look here, 50, and if I go up a dollar to 26.50, which is going to be this one, the delta is at 0.42. So it's a relative number. It's not quite exact, but it's very close, right? And so you can basically use it as kind of a barometer to look at the delta. When the price moves, how much of a change is delta going to be, right? And gamma is going to give you that number, right? So next, I'm going to talk about theta. Theta is really simple. It's the rate of option price decay at a particular strike. Right? So the closer you are at the money, the theta number is higher, but in relation to the option price. Right? So it's a lower in percentage compared to a further out of the money strike. So I'm going to do a little bit of math for you here so you can see exactly what I mean. All right, so we're going to look at the money, 165, and theta is 0.05, right? So if I do 0.05 divided by 1.65, that's 0.03, and this basically means 0.03% theta decay on that option, right? But if I go to, let's say somewhere that's not super far out of the money, but let's go right here to the 30.5 strike, right? So the price for this option is 50 cents, right? And theta decay is 4 cents. So if I do 4 divided by 0.5, now I'm looking at an 8% theta decay. So it's 3% at the money, and then the further out of the money you go, the percentage increase on theta grows. Even though the number itself shrinks, the percent decay grows because the option contract price is much cheaper. So you have to keep that in mind that whenever you're buying further out of the money, you're actually increasing your theta decay, right? I guess another thing that I want to discuss with theta is that I have a general rule of thumb that I've mentioned to people when buying options. When you enter a contract, you typically want to be out as fast as possible to avoid theta decay, right? But if you're forced to hold that position, then it's best to really target being out of it at 50 days left of expiration, unless you've got a percent loss that you're willing to take before that, right? So, for example, if you buy a 30-day till expiration contract, it's best to be out of that position by day 16 or 16 days left until it expires. Because if you aren't out by then, it's going to be very hard to see profit at this point, and any negativity towards your position is going to be more exponential. Right? So that's what I would say that the theta decay at this point in the contract or in the time frame of the contract is going to be an exponential loss if it goes against you at that particular time, right? Okay, so Vega is the next one, and this shows the rate of change between an option's value and the stock's implied volatility, essentially showing the option's contract sensitivity to volatility. So Vega will indicate the amount of an option premium changes due to 1% change in implied volatility. So in this current example, we're looking at 0.02. So let's go back to at the money. So 0.02. So for every 1% of IV change, the option price will change by 2 cents, right? So that's what this Vega means. So when IV moves 1%, the the contract value is going to change by 2%. So if the implied volatility goes up, then this contract's going to move up by 1 or 2 cents. So it's going to be 1.67, right? One other thing I want to note about Vega is that during earnings or some kind of anticipated news event, IV usually changes at a much faster pace. So it's really beneficial to understand Vega in these types of situations. All right, and last, and I would honestly say it's probably the least, is Rho. Rho is related to interest on the actual market as a whole, right? So the Feds, they change interest rates to adjust the market and bank lending and all that. So if interest rates change positively by 1% on this particular strike for Rho, you got a 0.01. So if the Fed says we're gonna raise interest rates by 0.0, or I'm sorry, by 1%, then this contract value is going to go up by 1 cent, right? So the reason I say this is the least important is because let's be honest, the government doesn't really change rates all that often. Once they start really moving rates, and this is something when the economy starts growing again, and there's a lot of jobs and people are making money, then they're going to start raising interest rates. And typically, when they do raise interest rates, it's usually a 1/4%. It's not even a full percent, right? So this is really not going to make any bit of difference. So Rho, I think, is the most least important of all the Greeks. All right. So hopefully everyone has found this beneficial and educational. Um, Please do subscribe to the channel and like this video. I would really appreciate that, and that would help out, Only Options server, along with this channel, getting this information out to people that are eager to learn like yourselves. So thank you, and we'll see you again.